Hello and good morning, everyone. Welcome to Almus Market Mornings, your daily dose of global financial updates with me, Swaraj. US CPI was the talk of the town yesterday, with bets being placed on whether the inflation cooling story is really in place. Post the numbers yesterday, where we saw the US CPI come in below market expectations, there was a risk asset rally. Sharp fall in dollar index, rise in euro, pound, basically all majors against the dollar. Equities did well, equities did well initially, but gave up their gains during the closing. While the story is on one side, rupee did not partake much into all of this and experienced only a slight strengthening in the NDF markets. What concerns me is the fact that on a weak dollar story, rupee is still weak against the dollar. JK, what are your thoughts on all of this?
Good morning. Obviously, the much awaited US inflation number, which is a key indicator for the markets and the economy, came at a comforting lower level, igniting a rally, as you said, in various assets. Coming at 7.1 versus 7.3% expected, and 7.7% previous month was the second successive month of fall and was the slowest pace in nearly a year. And the last month's surprise came with the caveat that it was just 1 month data, but the November number adds a further weight to the interpretation that the long-awaited goods disinflation is showing up in the data, led by declines in used car prices. Evidence of easing inflation is definitely welcome, but what may still be the focus of policymakers is the wage inflation that is still high. Last jobs report showed earnings double the expectations, and also services, particularly the rentals, which is not relenting. Although one good news is that the rent inflation remains high at 7% per month right now, but the lead from the new rentals give confidence that there will be moderation in the coming few months. As for the policy implication, I expect Powell tonight to stick to data-dependent stance again and see how the economy reacts with a lag effect of past hefty rate hikes. While inflation number may be comforting, but the market celebrating it with stock and bond rally, resulting in a benign financial condition once again may not be to their liking, as inflation in absolute term is still quite high. So irrespective of what the dot plot would indicate, the market is veering towards a taper in rate hikes. That's 0.75 last meeting, 0.5 today, and possibly 0.25 in February. The market expectation of terminal rate is also lower now, below 4.9%. So we should expect a kind of dovish tilt in Fed speak today, but caution against getting too too optimistic about the inflation coming towards a target of 2%. Gains in treasuries resumed yesterday, 2-year down 17 BP to 4.21. And the 10-year was off by about 12 BPs to 3.49%, but still above the 3.4% hit earlier this week. The 2s and 10 curves deepened to 73.3%. That is not surprising. As you said, equities were modestly higher. Nasdaq was higher, gained more. But interestingly, European stocks gained much more, with yesterday's rally resisting 1.7%. There, the lower inflation as well as the region's economy doing well has helped. Zoo economic sentiment survey for both Germany and Euro area showed good improvement, though they still remain in negative territory. And again, UK, which is the other economy in focus after the recent turmoil, showed one more positive number. The employment data coming on the back of positive GDP numbers released on Monday saw the employment roll increase by 107,000 to a record 29.9 million. Unemployment rate came slightly higher at 3.7%, but wage inflation was higher again. Data overall adds to expectation of 0.75% increase by BOE tomorrow. But on balance, ECB and UK should be raising by 0.5% irrespective of so the marginal expectations of higher rate hikes. And this seen together with the Fed, which might go for even lower rates from February onwards, really supports the currencies against the dollar. In fact, Euro and GBP have been on a roll. backed by good economic numbers and hawkish moves by the central banks. It's not surprising, therefore, that DXY saw a fresh low for this quarter. Fall in yields have aided yen strength and precious metals. One thing that the market is possibly looking at is further dovish tilt in the Fed speak. Also, if there is a disappointment, we might see some retracement. All said, major currencies have had a big move. Euro 12% up, GBP nearly 20% up from the low levels, and yen around 10%. And as we head into the year end, once we are through with Fed meeting today and BOE and MPC tomorrow, we might see currency players looking to take profits, and dollar index gaining a bit out of its losses. On the rupee, it does feel USD-INR is trading in a different world, guided by its own unique influences and quite oblivious to the traditional factors that could determine its direction. It was a reaffirmation of the same, with the rupee falling to 82.90 yesterday, though it was after the OTC market closure. And since the dip in 81.15 seen last week, we have seen strong buying from importers and other outflows continuing in yesterday's trading as well. In yesterday's trading, we did hear RBI selling around 80 to 70 levels, but not very persistent. And as soon as the market buying intensified, they moved away, leading to a further fall in the rupee. Also, we see some sense of benign neglect of the rupee weakness by the central bank and a reluctance to intervene, which is quite conspicuous. This might encourage speculative longs in USD-INR if it continues, and a possible erosion of confidence, and that's not good for the rupee. So that itself may keep the foreign investors also away, adding to further weakness. Just to mention technical levels, 82.10 and 81.80 remain supports, and 83.25 and 84 remain strong resistances. Of course, 83.25 was the previous all-time high, so it could take some effort to break it. But if it does break, a swift move to 84 is not ruled out. Thank you.
Thank you, JK. And just to summarize, US CPI did come in lower, 7.1% versus 7.3 expected. We saw yields fall across the board, while yield curve is still inverted. There are some improvement in the European economy, and the Bank of England is expected to raise its rates by 75 basis, while rupee is, of course, trading in its own world. Currently, the market is celebrating with this drop in inflation numbers. Now it's prudent to be aware of any such change in stance which can cause a dollar rally. While it seems ECB and BOE are out-hawking the Fed, it also needs to be observed whether this will continue. So keep managing your risk. That's it from us today. Thank you so much for listening.